Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching. Greatly appreciate all the comments and subscribers. Thank you. All right, today we're going to look at Bank of America. This is part of our bank series. We're looking at Wells Fargo, JP Morgan Chase, Citigroup, and Bank of America. Before we get to bank, let me recap. This channel is dedicated to intrinsic value. What we do is we hunt for what we believe the intrinsic value is. We look at the market price, we compare the two, the intrinsic value and the market price, and we look for that delta. That delta is our economic return. We look at intrinsic value under 5 key attributes: top line revenue growth, earnings growth as we define it by EBITDA, free cash flow growth, strong balance sheet, and a well-priced stock. Now, as I've said in the other banking videos, banking companies are slightly different, right? Their cash is their raw material. They don't have manufacturing or servicing costs, and their borrowing, their deposits, and their lending. It's very difficult to tell what cash is attributable to operations and what cash is deposits or loans provided to customers. So what do? We're going to look at an earnings yield. If net income is the earnings yield, and we're going to look at book value as how they utilize their assets to generate positive earnings. Okay, let's go dive into Bank of America and take a look and see what we get. Behind me is about a decade worth of revenue for Bank of America. And what you're going to see is the top line revenue has 2 facets to it. It's got the net interest margin. Net interest margin is the difference between the interest rate that they have to pay out to customers and the interest they receive from lending money out. So the example would be if you deposit your paycheck with Bank of America will pay you a very, very small interest rate. Let's say it's 1%. I know it's not. For example, let's just say it's 1%. They then turn around and lend that money to someone to buy a house. That mortgage interest, say it's 4%, the bank is receiving. The bank is receiving 4%, paying you 1%. They're keeping 3%. That is their net interest margin. That net interest margin is applied to the total assets. That's how they get that revenue. The other piece, that would be banking fees, investment banking fees, market making, when you pay for a checkbook, if you still use one, you pay a fee. If you send a wire, ACH, all those little fees add up. That's non-interest revenue. We combine the two for total revenue. In the interest for Bank of America, it is flat over the decade, which isn't a great sign. It's one of our hallmarks. We want to see top line revenue growth. Here, they don't have it. What they do have is they have net income growth, right? But this net income is arbitrarily low, $85 million to $25 billion. That doesn't make any sense. What you'll find with banks is they have more volatile earnings. Why? Because their assets are marked to market on an annual basis. That mark to market means the change in value is expensed on the P&L, so it's either fictitious expenses or fictitious income, and it causes larger swings in net income. So I wouldn't take this growth rate as obviously continuing. It's kind of more or less been pretty stable for the decade with a slight uptake. The last couple years, the economy has done really well. All right, let's keep going. Let's take a look at some average margins. Average margin recently here is in line. That's about 20%, which is in line with industry average. I think this is arbitrarily low. I wouldn't penalize them for that. Shares outstanding have been coming down 1% a year, 1% a year over that decade, which is what we want to see, right? We want to see a company buying back its shares. It's a tax-free way of rewarding the shareholders for staying with the company. That means that your ownership grows by 1% a year without doing anything, and you don't have any taxes to pay on it, which is very nice to see. You'll also see it's kind of a compounding effect on earnings over the long term. We'll get to that in a second. Earnings per share here again is grown, but that growth is fictitious, right? That growth is largely because the 1 cent of earnings a decade ago. More recently, it's had a nice uptick from 3.8% to 2.2, 3.8, $3 and, $1.38 to $2.77. Boy, I can't talk today. And then you've got her share price and the earnings yield. So this covers the income statement for Bank of America. It's been very good recently. Very, very, very nice. Let's go through and look at book value, see what they've been doing with book value. All right, so what you got here is you start with $2.1 trillion of assets for Bank of America, and they've grown that to $2.4 trillion. 1.7% is the growth rate. Not strong, but above inflation. Less goodwill, less long-term, less total liabilities, and we get book value. Please reference some of the other videos in the bank series. I go into more detail, goodwill and total liabilities. But basically, total assets, less goodwill, less total liabilities gives us book value. Book value for a bank, because they mark their assets and liabilities to market annually, it's much closer to actual liquidation value than a traditional manufacturing company, which capitalizes cost at their original purchase price and can be stale. Here we know it's mark to market data, so it's fairly close to what they could get in liquidation, and the book value is a reasonable estimate of that. Book value per share, that's it, book value divided by shares outstanding, and the change in that is the growth rate. Last, we've got market cap, shares outstanding times price, and finally, the market multiple that we look for a bank is price to book. Here I'm taking market cap of the company, dividing it by book value, and I get a ratio of price to book. That's basically how much you're paying for the book value that you're getting. And what you're going to notice is over the average, it trades for about book value, 1.1 times. It's been as low as 0.4%. Again, I think that's arbitrary low because that down year that we had, I probably wouldn't count that. You're probably more in this average range of 1.3 when it kind of stabilizes up here. Let's look and see what they're currently trading at. So the current trading is, I think it's $23 a share. So if I plug in $23 here, $23, I'll get the current book value here, which is 1.1. So it's trading at basically its long-term average. Our long-term average, just to cover what I did there, long-term average is 1.1 over the roughly decade. If I take the current price, market cap of the stock, and compare it to the last book value I had at the end of the fiscal year, I'm trading at 1.1 times. So there's really no market multiple expansion we're going to get here. It's any appreciation we get is going to be solely based on earnings, growth, and the share buyback. Okay, now let's forecast forward. We'll forecast book value, we'll forecast earnings yield, we'll come up with future value pricing for Bank of America. All right, picking up the book value that we had previously, again, just like with all the banks in this mini series, I'm not assigning any growth to book value the next couple years. This is a hedge because I really don't know what's going to go on with COVID. There could be large write-down loomings. There could be underperforming loans. There could be companies that go bankrupt that Bank of America has extended credit to. We just don't know, so I'm not going to grow it. I'm going to say that over the long term, it's going to pick up at 3.9% growth, which is what it has been growing book value historically, and it'll continue that for 8 years, so to 2029, for $265 billion of book value. I give a slight premium to that because I'm using the 1.1 price to book value, and I get a market cap forecast of $293 billion. Less divide by shares outstanding, I get a price forecast of $34. All right, let's look at net income and forecast going forward. Here, earnings, $2.35. That's an average for the last couple years. Again, following the same pattern, no earnings for the next couple years as a hedge to protect us as investors. And I'm going to grow this net income, this earnings per share, at the book value per share rate that they have been growing historically, and that gives me just shy of $60 at 59. Okay, so we have two estimates of future value, right? We've got $59 using net income and the book value per share growth rate. And I've got the book value multiple at $34. Two different estimates, two different methods. We'll average the two to come up with a guess at what we believe the intrinsic value of the stock in 2029 is worth. And that is $46 a share. It's currently trading at $23, so that's roughly double over 10 years. What does that look like in IRR? Here we go. $23 in the investment, no cash flow from the no earnings for the next couple years as a hedge to protect us. You should probably still receive a dividend, so that would be an upside if received. Going forward, you've got your net income, not cash flow, I agree, but when we're doing this, we don't have cash flow per se. It's more difficult, so I'm using net income as a proxy. And I've got a long-term value of $46 per share. That gives me a 16% IRR, which is above market over 10 years. You're in one of the largest banks in the world, and I think it's decent. I would like to see top-line revenue grow. I'd like to see book value grow a little bit more, but they are buying back shares. That share repurchase helps boost earnings over time. There's no market multiple expansion here, so I think that's capped the upside. If for some reason this should trade down, I think it's a very interesting entry point if it trades lower. 16% is your discounted IRR over that 10-year, and you make 3 times your money. If I go out into the future and we say, I want to see what this looks like if I know that the intrinsic value is and the stock price is going to move all around that number, what kind of return do I get as share price moves around? Here you go. $23 is the current price. Top line is what the market price if you bought the stock. The bottom is the IRR, assuming the same intrinsic value in 2029. And you can see you start getting around 20% in the high teens on the stock price. Not sure if it's going to get that low. If it does, it's definitely a buy. Here, I think it's appropriate at slightly above market. And then as it appreciates, I'd hold off because I think there's better investments out there. All right, my name is Cameron Stewart. This is Rational Investing. Thank you very much for watching. I hope you enjoyed this review of Bank of America. Please comment and subscribe. Thank you very much. Take care. Bye-bye.